Good morning, good afternoon, or good evening, depending on where you're listening. Welcome back to AI and the Future of Work. This is your host, Dan Turchin, advisor at Insight Finder, the system of intelligence for IT operations, and CEO of PeopleRain, the AI platform for IT and HR employee service. Thanks again to all of you, our listeners, for making this one of the most downloaded podcasts about the future of work. If you enjoy what we do, please like, comment, and share in your favorite podcast app. And we will keep sharing great conversations ad-free, like the one we have today. We meet entrepreneurs frequently who are building startups with venture capital. We talk about their bold visions, the future of technology, and how they're using AI to improve work life. We also meet venture capitalists who fund those entrepreneurs. Well, today we've got a treat. We're at the intersection of the two. Shawn Merani is an entrepreneur whose startup is a venture capital firm called Parade Ventures. Shawn identified a gap in the pre-seed and seed venture market and raised his first fund, Flight Ventures, a few years back. He helped launch some bold companies using things like AI for veterinary diagnostics, and another one of his previous investments, RecruitBot, uses machine learning to source candidates. Before venture, Shawn was an operator at companies like LiquidNet and Reach Local. Today, we'll learn how to identify and pitch entrepreneurs who have so many options at the seed stage. As you'll hear, being a VC also requires hustle and certainly perseverance. LPs, or the limited partners that invest in venture funds, can be every bit as demanding as VCs on startup boards. Shawn also has, let's say, an encyclopedic knowledge of Cal sports. And since I'm still licking my wounds here, but Cal pummeled my Stanford Cardinal a few weeks back in big game. I'm going to let Shawn gloat just a little bit on the podcast, but one time only. And I'll take this opportunity to remind him that we own the 124 game series, 65 to 48 to 11. So I don't know. The Bears have got a little catching up to do. And by the way, we've won 10 out of the last 12 big games. But I don't know.
Who's counting?
That's just an aside, all right? All right? It doesn't matter all that much. And in 1982, that was just an anomaly. Next year, big 40th anniversary of the play. We got a lot of sports we could be talking about, but I think we're going to stick to venture for today's session. Without further ado, Shawn Merani, welcome to the program. Why don't you share a little bit about your background and how you got into this space?
Yeah, thanks for having me, Dan. It's always fun to talk to you. Yeah, I accidentally got into the space of investing. As you mentioned, was an operator, an executive at a public company called Reach Local, and then started up a company funded by LiquidNet, a marketplace for investing. Started me and my former partner at Flight VC, or current partner, Gil Penchina, we identified an opportunity. There was a small company called AngelList. They just released this product called syndicates, which are turnkey vehicles or special purpose vehicles or entities to invest in startups. And we thought that was an interesting way to give exposure to people that didn't have access to startups, but wanted to have exposure to venture capital. So it was more of our problem solving hat on, and that we had an idea that we wanted to address. So we kind of just went for it. We didn't go raise a fund or anything like that. And we had been angels and advisors. And so we had access to deal flow. Oftentimes people ask us, like, what is your edge? What is your advantage? And we were already sourcing from our network. And so we built that out over 4 years. And so that's how I got into VC. I didn't join a fund. I didn't come out of, a PayPal or a Mafia, or a big company. Kind of just got into it through a void that we saw in the market. What I learned over those 4 years, is I love working with founders. I love working closely with them from the day zero, helping them find product market fit, helping them get their early sales and really stay close to the customer. And so, that's kind of what I evolved into at Parade is, we decided to launch in 2018 and, built on those learnings from Flight VC, but, doubling down on that partnership aspect of working with companies. And so we invest at the earliest stages. You can define it as pre-seed and seed, but we tend to come in early, high conviction, high ownership in companies, and deep partnership. We invest across enterprise is kind of the broader sector that we invest in. But there is a diverse set of companies that sell to businesses that we do invest in, but they usually have high margins repeatable sales models, subscription revenue. Those are attributes we usually look for. We're all about the founders. We want to be their first call. And we get feedback, as they go raise follow-on rounds, like things like we count you as founders. We wouldn't be here without you. Not something I ever would have thought, ask for or thought someone would say to me. But when you get that feedback, voluntary feedback, is really, it's kind of why we do this. So it's pretty amazing and a blessing to be at Parade and be able to back these amazing people.
I don't think non-investors appreciate how hard it is to raise a first fund as a venture investor. When you have no track record and you're going out and pitching prospective LPs, what's that process like?
I don't know. I think anything in business at the end of the day, maybe sales, it's all sales at the end of the day, and it's driven by a relationship, and so I think it's building that trust over time, and really a track record is an indication that you're able to do it, and there's validity to that, and they call on references, they'll call on those companies. So I think it happens fast for some, but not for most, I guess. It's probably you always hear about the success stories, the ones that got faster, or the revisionist history that might not be the actual history. But I think anything, entrepreneurship related or starting something from zero, it takes work. And so, much like, you probably talk about any company, you got to understand your customer. So, I look at myself as a middleman, and I have two customers. My customers are my limited partners, and my customers are my founders. Luckily for me, I've always been working with founders, and I've been one. So that side comes pretty innate to me. But I had to learn about the new customer, which is the limited partner that you referenced. So ours tend to be individuals, family offices, and fund of funds. And I had to really understand them, what they were looking for. And I just realized, building that relationship, validating the model, just like we take risk in founders and companies, they were taking a risk in me. And so some were willing to take that risk earlier than others. And I think they're going to benefit highly from it. And some over time that we just got to know each other and nurtured, that sales process. So it was a learning for me. Did a bunch of things right, did a bunch of things wrong, like we all do, make mistakes. But like I say, in entrepreneurship, the best investors hopefully have some timing and good luck and market opportunities, but try to make some more better decisions than poor ones. And I think I've done that as well. So that's why we're here. We're turning the page to fund too. So I think the fact that we're still alive, like any startup, it's a blessing.
You have an amazing track record. Now, on the outside of the startup ecosystem, the perception is that money's free flowing for startups, and the perception is that money is free flowing for new funds, given the volume of funds being created. On the inside, it's hard. It's damn hard. It doesn't always seem like it's free flowing when you're an investor or a startup entrepreneur. Which is harder, raising money for a company or raising money for a fund?
I think it's harder for a fund. It's ironic. It's like you're giving, the investor is the investor, whether it's a venture investor or an individual, and but those folks like to get there. I think the market's really good. Companies are doing really well. It's going up and to the right. Everyone can, like a lot of people can look smart. But at the end of the day, a venture fund is a diversified pool of assets, multiple companies, less risky. Still a ton of risk. These companies can go to zero. We're investing in them. We're investing in people. We're investing, pre-product, like really hard, as you mentioned, Dan. But people like to go direct and like to, do the quote unquote sexy part of the business. But it doesn't make sense from a math and portfolio perspective. By definition, if you want exposure to early stage, you should theoretically want to invest in a fund over a direct company. But people I think they find it challenging. It could be we charge fees at venture funds. We have to run our business. Otherwise, we wouldn't be making money for probably a decade or maybe 5 years. And that's just not sustainable living in the Silicon Valley. And if you have a family or dependents, that's a challenge. So that is the model that you have to run by. You have to be able to run your business and live day to day. So that could be part of the rub, but I don't know. I found it to be very challenging, to raise a venture fund. And also I think it's just generally hard. You're investing blindly in a person, really, right? In a company, you're saying, hey, I'm going to invest in this person solving for this opportunity. Let's not talk about the pivots that happen after the fact. But for a venture fund, you're investing in a decision maker that's going to invest in a bunch of companies, and hopefully has a go-to-market. So it's pretty opaque from that perspective.
One of the things that really impressed me about your track record is you've managed to get access to some pretty exclusive rounds that have ended up being super oversubscribed. Like I know you recently announced an investment in Intro with co-investor Kevin Durant, and you're in some pretty high-profile deals. Tell us about how you hustle. How do you get access to some of these deals that presumably, tons of other seed funds would give their eye tooth to be in?
I don't know. I focus on founders. I don't think I think when we meet people, we don't know it's going to be a hot deal when it goes down, and when a market gets created and a bidding war occurs. Oftentimes, as the pre-seed and seed investor, we might be in the press release with all the notables, but we might have gotten there before them, and taken on a different kind of risk. But we focus on two things. We focus on, really predominantly people that we back. Building a relationship with them. We're not Sequoia Capital and Parade Ventures. Most of you listening probably have never even heard of us, but we focus on the person across the table and building that relationship and helping them. We think that differentiates, that helps us win. And we're taking so much risk that there's plenty of opportunity for us to find opportunities. And then, we don't worry about that other stuff of who's coming in the deal, who's looking at the deal. We focus on the founder, and if we back the right founders going after the right opportunities, we think we'll be fine. So I think just where do you want to spend your time? So definitely that is not how we think about it. But definitely super amazed to have our limited partners. Some of them are investors also and later stage investors, but also just fortunate to be able to co-invest with, some great people, from individuals to amazing founders that now in angel invest and some of the best funds in the world. So, definitely don't take that for granted.
Tell us a story. Give us an example of where you had to hustle and kind of maybe cultivate an entrepreneur and,
I'm always hustling. The definition of our fund is hustling. We meet our founders every other week. Like, our model is we do a bunch of work up front, which is not for everyone, but the whole thing is we take so much risk, we spend so much time that we want to get to know the people that we're investing in. We want them to get to know us, not only just evaluate the business and the market and if they have built something or not. We want to get to know the founding team that we're going to collaborate with. And so I think that if you run that kind of process, like, you are hustling. And I think the more time you commit to each other on both sides, the higher probability you have to win that deal. And so I think, that is our hustles every day, but we are lead investors for the majority part. So, sometimes we get to an opportunity late and we can't get our ownership, and sometimes we have to pass because of that. TBD on if, it's for Parade, it's a little too early to say if that was a good decision or bad, but we have stuff in our portfolio that we identified early that are doing really well, that we're pretty happy with the people that we've been able to work with and that match our strategy.
An example of an entrepreneur who you met who just blew you away, just someone who even before you wrote the check or did much diligence, you're just like, this person's gonna be a success.
Yeah, one of our best performing companies is a company called Sonar. They're change intelligence software. I met Brad Smith, the CEO, in November of 2019 at Dreamforce. He was here for Dreamforce. He was still at his previous company. He had been bootstrapping this company on the side with one of his former colleagues, Jack. And I met him, and it's less about spending time on the business, which is change intelligence software, but he's this guy from the South. He was out here, in the Bay Area, and, we had a meeting and he had brought me a coffee already. And no one had ever done that before. He never met me before. We'd done a phone call. And so I told him, I was like, that impression mattered a lot. So that doesn't mean you have to bring me a coffee every time, but that was different. It showed like his Southern hospitality, I guess. And then, talking to him about the subject matter, he had hustled on the side, built a business, had some small, tiny paying customers. And then talking about what they were building, he was building a product, change intelligence software, that was built for his former profession. He was the IT ops guy managing Salesforce at multiple companies. And he would be, he's essentially an engineer integrating all of the middleware into Salesforce, and things would break all over the place. So he built software to solve that problem for himself. And so, that point of view, that experience, that pain came across very clearly. So I knew from the moment I met that person, I was like, high integrity, very respectful, very thorough. Any question that I threw at him, if he didn't have an answer, he would figure it out or get me that answer. So I just knew he was obsessive about the problem. And then meeting his co-founder Jack, like together, they're just a tremendous, yin to each other's yang and team. And that's proven out over time. So still early days, but we've joined in that investment by some terrific investors, Craft Ventures, Slack Fund, and we'll be adding some more soon. So pretty excited with that one.
All the entrepreneurs listening, replay that last 2 minutes and listen to that over and over again. That's a great answer. And go out and follow Brad Smith and Sonar. Craziest pitch that you've heard in recent memory? Just that moonshot, crazy idea that you didn't see coming.
I don't know. I mean, you mentioned the veterinary diagnostics one. I wouldn't say it's crazy or a moonshot, but for me, it was weird. I mean, at that point in time, like I didn't have a dog. We have a dog now. We got one, adopted one a couple months ago. But like, they were building, they're using AI machine learning. So stuff that we know, right, Dan? But leveraging it for biotech essentially and looking at complete blood counts and then turning it into data and and leveraging that data to interpret, that blood sample faster and to have better outcomes for pets. So they had nothing when I met them. They were two 22-year-olds and a 27-year-old PhD. They didn't come out of Stanford like you, with term sheets being handed to them from across the street, but they were into Penn State. And so that was, to me, was a moonshot, but I got to know them over 4 or 5 months, was introduced by an angel investor, and got really captivated by the way they were making decisions and thinking about things, but they had zero, they had nothing. So we took an early bet. So I thought that was, I think in hindsight, that was one of those when they raised their Series A. I said, take a pause and celebrate this moment, and just like appreciate that you're here and you have revenue and you have this great partner that wants to give you more capital. Like I can't, you did it. You celebrate this milestone. He's like, I can't believe you gave me money, and because I was the only one that would, lead us around and make it work. And so here we are. And so it was a moonshot. It was a risk because he's 22-year-old that had no business being out here. And here we are. So they're about to cross the 1 million in ARR mark and, probably raise a bunch more money, but they have really good product market fit and they've done exactly what they've said. So it's pretty cool.
Beautiful. And I know you're building a whole portfolio of companies like that, but yeah, that's a great story. An idea that you'd fund tomorrow, if it came across your desk, assuming decent team, and
I don't look for decent teams. I think I don't invest like that. I'm a people person. I'm a bottoms up. Like we have our enterprise strategy. That's our top down approach, but we're bottoms up, man. We are people. I learned from Brad. I had empathy for that problem. Had been used Salesforce at various times in my career. Surprise. Hasn't changed much, maybe better UI, UX, but like essentially does the same thing. But we learn from them. We learn from their point of views, and sometimes we have experience with Salesforce and we can move faster because we appreciate the problem, or we don't, like Moicor, right? Where we have to learn and go deep and learn from them even more acutely, and so it depends. But yeah, we're very people driven, very background driven, to figure out what is their edge, what is their wedge. Is it distribution? Is it a point of view they've developed, right? Are they going after an incumbent? Or are they creating a new market, which I think, Sonar is doing? Or are they going after legacy infrastructure players in the veterinary space like Moicor is doing, right? Very different. So, we trying to learn and collaborate and challenge their thinking, from the early days. And that's our approach, very bottoms up.
Have you ever sought out a team solving a particular problem as opposed to kind of reacting to teams that come to you?
I mean, there's stuff that we think about and spend time thinking about, but I've been investing for 7 years and I know other people that have, it's just hasn't worked for us. And so I just don't think that's a good use of time. I'm a solo GP, one person. I also only have 24 hours in a day, 7 days in a week, 365 days in a year until you invent something, Dan, to change that. It's you have to be very deliberate and judicious about your time and where you invest it, understand where your strengths are and where your weaknesses are. So me having an idea and go searching out and incubating essentially a team to do that is just it's not the strategy that's worked for me in the past 7 years. Not to say that I wouldn't do it, but I don't think it's you gotta play to your strengths.
we had a founder on here a while back, a few months back, Z Wang, who's founding a company called Timeless, who's trying to give us all back time. So look, I can't claim to be solving that problem, but I know there are people out there trying to do it. It'll help both of us. So you see, I'm sure hundreds, if not thousands, I don't know, of pitches a year. What's the most common mistake that founders make when they're pitching?
I just want to feel coming out of the meeting that they've thought more about that problem than I have. Going into a meeting, I've looked at your deck maybe, right? So I spent a couple minutes on it, and that's probably about it. And so going into the meeting, especially a first meeting, right? I don't know you likely. Like, let's pretend it's someone I've just was introduced to. I want to focus on you, and I want to ask you, get to know you, number one. Like, so let's focus on building that interpersonal relationship. It's not just the business. Oftentimes you invest in people that pivot their business that are still successful. So don't forget that. The second part is, when you're talking about your business, and I've spent literally 2 minutes or less on your business, and I have asked questions that either you're BSing the answer, which usually, you can sniff out by follow-up questions or in the moment, or you haven't thought about it. You're supposed to be the one as the founder that's obsessing over the problem every waking day and hour, and you're sacrificing time with your family or friends or whoever, your life. You're sacrificing your life to build something else, to create a company, to create jobs, to make an impact on whatever that impact is. So I would just like to think that you've thought a little more about it than I have. And so that's what I hope out of every conversation I get. And so, but usually, if you get to the point where you're in a meeting with me, to your point, I see a lot of decks every year, and it turns out to be not fruitful or not thoughtful. I usually blame it on myself. I don't blame it on the founder. I'm like, hey, rethinking my process on how that meeting happened. But we try to just leverage our filters, again, going back to time and being maximally efficient, because we don't write checks every day, right? We write maximum of 3 core checks a quarter, and that's high. It's usually 1 to 2 every quarter. So we're meeting a lot of companies, and we're seeing a lot of decks before writing a check. And so having that process and checks and balances and filters before someone can get to us is very important.
I think every investor develops an anti-portfolio over the years, and you've been doing it for 7 years. What's one example of kind of the one that got away, where you heard the pitch and just didn't buy it, and then they ended up just going stratospheric?
I wouldn't say one that I didn't buy it. Usually good entrepreneurs are good entrepreneurs, and like they're onto something. And like, I wouldn't say there's one that was like, no way that's gonna work, and it did, that I at least want to mention. But I'd say like one that I got really close to doing that I talk about. It's like I think I talked about it on this other podcast, is Chime. Chris Britt's a good friend, and I really wanted to do the deal, and had a partner, and he had seen a bunch of the companies, going out being neobanks or challenger banks, and this hadn't worked up until Chime. Chime was like the first one that really worked, and for a variety of reasons. There wasn't any fintech infrastructure before, and all these other reasons, right? Sometimes timing and technological innovation can catalyze a category or a business. But I really wanted to invest in that business, and I ended up passing, and we ended up becoming pretty good friends. He's an advisor to Parade and an investor, and yeah, it's they're doing big things, right? I'm sure they'll be a public company in the next couple of years.
What's your philosophy on your involvement in boards? When would you take a board seat, and how are you as a board member?
A board seat is not a necessity for us. Like I said, we're super partnership driven. So we're meeting our founders every other week, which is more frequent than any board meeting. And, honestly, we're helping them build that foundation of KPIs and tracking and business, metrics that are going to make them successful. Oftentimes all that stuff will bubble up and be the foundation of their board deck in the future. We are on a few boards. I am on a few boards. But it's not part of our strategy, because we're gonna have to have 20 companies in fund 1. We're gonna have like 20, 25 in fund 2. Like, it's just not feasible for one person to do that. And then we're already kind of doing the work anyways. And so, I'd like to say we're very aligned with the founder from a board perspective. We are founders. We're there from day 0. And so we want to support them and back them rather than, create trouble for them. Of course, we want to challenge them. But just the board thing is just not part of our strategy. If I had another partner for this fund, which is not how it's going to be, maybe it would be different. We'd have more bandwidth to do that. but I don't think our governance is any different. And more importantly, like we have the ownership in the company, so we have like the shareholder voting power and influence to be able to affect the company. So I think a board seat's important, but when you're going 0 to 1, it's like it's hard. It's hard enough to find product market fit at the early days and hire people when you have a very small number of people on your team, and then you have to prepare for a board cadence. We just don't think that's important at the pre-seed and seed stage for our fund, for the round sizes that we're participating in.
I think just like being a great investor is a skill set or an entrepreneur, I think being a great board member is its own kind of core competence. Who's the
Totally.
who's the best board member you've seen?
Oh, I don't know. I see. If we're on a board, like we don't do board observers. I did that once. It's just, and I'm still on it, and it's fine. It's just you don't have a. It's just a waste. It's not a waste of time because we spend so much time, but it's another obligation that you have to give your time to, and you don't have a board vote. So it's like, why? I should have taken a board seat if I was going to do it. Was my learning there? But we're only on a few boards, and they're at Series A, so there's like not that many board members already. So, and this is the first, for Parade is where we're doing the really much higher ownership strategy. So I wouldn't say I have enough data to say like who's the best board member. We work with a lot of great people, especially at the seed stage, that are great. And I think as you attract board members and follow on rounds from different firms that are bigger, they also, to your point, bring their own strengths and weaknesses. And then there's the final thing is like, if you're on the board and there's another seed investor and there's the founders and there's a new board member, it's like, what is the dynamic between those 4, 5, 6 people, right? That's unique too. So it's just like any team, any culture. And so I think all of these situations are unique, and it's important for everyone to find their role and, balance each other out. I think that, you want the sum of the parts to be less than the whole group together.
Have you ever had to replace the CEO, and if so, how do you deal with situations when your leadership team isn't performing?
I haven't had to do that. From my perspective, I'd rather, if it's not working, I'd rather have it not work sooner. But I haven't, for what we've done and how long Parade has been in business. Maybe from my prior fund, we've had investments where we were smaller owners and we just spent less time as as our ownership became diluted, where we'd have an effect or connectivity to make that decision. I've been an investor in a company where that has happened, but we weren't part of that decision. It hasn't happened yet with Parade. Still too early. Thank goodness, like our successful CEOs are still the CEOs of the business.
In Silicon Valley, we're notorious for feeding hype cycles and lemming-like behavior sometimes following the last biggest hottest deal, whether it's now it's Web3, but in the past it was mobile and it was social and green tech and clean tech, etc. What's your perspective on investing into a hype space like maybe fintech or Web3 is an example for right now?
Well, I'm constrained by a few things as an investor, like our fund size and our model, and we try to get some certain ownership. So by definition, if an area is hot and there are a bunch of players and there's a lot of competition for investment opportunities, like price is going to get moved up because of supply and demand, right? It's Econ 101. And so, it's going to be hyper competitive and I may or may not get my ownership. And so given our fund size is about 15 million for fund one. Like we try to get 10%, like you guys are math people that are listening to this call, like it's probably not going to work. So I try to stay away from hype cycles. We have a high conversion to win rate, but I think just it creates a lot of noise too. And it's just harder to make decisions. I think unless you have like an edge as an investor. So, if I had a background in an area where it's hot and I can have an edge to win, maybe that would be different. But I think in stuff like Web3 or fintech, do I understand them? Sure. Do I have like a demonstrative edge? No, there are fintech funds, there are Web3 crypto funds, right? And then it's hypey to your point. So there's a lot of noise. And so instead, just philosophically, I'd like to just go in places that are going to be the next hot hype cycles. It's way more beneficial to me to invest in something that's not hypey before it gets hypey, then I can benefit from those market dynamics, right? And so that's just philosophically how I approach just hype cycles. I've seen, crypto was hot in 2013, 14, then it wasn't. Now it's hot again. It's called Web3. So like, whatever, don't get too caught up in that stuff.
But it takes so much more work to find the next big thing before everyone else has found it.
Yeah, it does. It's fun. It's fun when you can tell everyone I told you so.
That's right. So you got a lot of aspiring investors listening to this. What's your advice for, let's say, kids in college who, want to be the next Shawn and found the next Parade Ventures?
Shoot, I didn't even know I was wanted to do this. If you asked the younger me, but I was always interested in venture and investing, and thought it was interesting. So I think there was some fire in my belly for that. But I think I tell any young people, I told my associate, he's part time, go operate. I struggled to figure out how can I be a good investor if I didn't know how to run a business. That said, there's plenty of examples of it. Peter Fenton at Benchmark, met him once, but he's one of the best investors in history. He's a career venture guy. He's killer, right? He's one of the best. So there are multiple ways to skin the cat. I just believe having operating experience for me has been very helpful. It helps me build empathy with the founder. It helps me problem solve with them better. Helps me win deals. And so I think that is a very important skill. Everyone has a different opinion on it too, but I don't think good operators make better investors or anything like that. I just think having that point of view and having that experience is helpful.
Shawn, I got to get you off the hot seat, but one last question for you. I'm curious to get your answer to this. You're riding up an elevator with the famous person of your choice. Who is it, and what are you talking about?
I'm a big Michael Jordan fan. You see a poster behind me, Dan. I know this is not on video, so it's a childhood friend, a childhood hero, and I met him before. But if I was in an elevator with him, and I never talked to him, I met him when I was a kid. I'd ask him. Everyone saw The Last Dance, how maniacal he was, and I think it's different from when you're a kid and watching, this big star. I would just want to understand. It's hey, you became a multi-billionaire. You've innovated in many areas. Was it worth it? Was it worth it trying to be the best? Was it worth it having that killer mentality and literally not literally, but theoretically willing to slit someone's throat to win and be the best? Was that worth it? I'm just curious, but I think there's a lot of corollaries to entrepreneurship, right? There are maniacs in our industry that want to be the best, that become billionaires, etc. And they make sacrifices to do that. And so I'm always curious and what that mentality, and was it worth it?
I'd love to be a fly on the wall for that conversation. I said that was the last question, but I tease. I told you you'd get a chance to gloat before we wrapped up the podcast. So here's a softball for you. Who gets to a BCS game next? Is that Cal or Stanford? Seeing as we're both licking our wounds after miserable seasons.
I don't know. We're education. We're big big on education at both the schools, and I think we should focus on that. Yeah, I don't know. Probably you guys. I mean, look, it's been over 50 years since we've been to the Rose Bowl. Last time we were about to go to the Rose Bowl, Texas, and Mac Brown did a campaign to talk us out of it. So even when we deserved it, we didn't get it. So I kind of don't even think about it anymore. Just try to enjoy it, man. Just try to watch it. Watch the big game. Have fun. If we lose, it's cool. Don't be tied to the outcome. It's okay. We have enough outcomes, Dan, to be tied to, right? With our work, let alone our schools.
That's a great answer. I love.
We both go to great schools, man. It's awesome.
That's right.
It's a lovely thing.
So I got to go to the Rose Bowl when we played Wisconsin in 2000. It was an amazing moment when it was a terrible game. It was 13-3 or something. We lost, but Ron Dame was the MVP, and they give him the mic after the game. And I kid you not, the first thing he did is he turned to the Stanford section. He said, "I want to thank you for being great fans and for supporting your team." I was thinking, wow, what a pro move. It was an awful game, and he ran through us like a knife through hot butter. but yeah, I always respect the guy for doing that. So whether it's you or me or sometime hopefully maybe we're going to a BCS game together.
Yeah, I would love that.
Good stuff, Shawn. I'm sure there are others. A lot of our listeners would love to know more about Parade. Where should they go to learn more about you and the firm?
Website's parade.vc. You don't have to think too hard if you want to reach out to me. You can figure out my email address. It's pretty predictable, as most in venture. So, that's where I can be reached.
Shawn, this has been great. Good hanging out. And as some of these trends and some of your portfolios start to get super high profile, it'd be great to have you back and tell us more stories.
Sounds great. Thanks, Dan, for having me.
This is your host, Dan Turchin, AI and the Future of Work. back next week with another fascinating guest.